All right, and we should be live here. Welcome to Thoughtful Money, folks. I'm Thoughtful Money founder and your host, Adam Taggart. Again, I'm not so much the host this time because we are joined, as usual, by the wonderful Stephanie Pomboy. And this is the resumption of our Monday morning macro with the macro maven herself. Stephanie, how are you?
I'm great. Thank you so much for setting this up again. It's good to be back. Yeah, I had a little unexpected family business that needed to be addressed. But everything's good. Everyone's fine, and we're back in the saddle. So thanks for your patience.
Very glad to hear about that. We had a lot of people who went in a pretty severe withdrawal without their regular dose of Stephanie Pomboy. So folks, you'll get that dose today in spades. And you know, it's good, Stephanie, because really nothing happened in the 2 weeks that you were gone.
You know, I mean, I feel like Rip Van Winkle. You know, I wake up and it's pretty much just the same. Everything has been on autopilot. So yeah, I mean,
well, yeah. To the contrary, it's been an incredibly eventful and volatile. Actually, I guess it's been 4 weeks since we've had you on the show. So lots and lots to talk about. You did send over some charts and whatnot that I can just pull up at will whenever you want to talk about them, Stephanie. But it looked to me like an important theme from the data you sent over was that, you know, we are seeing signs of stagflation around here, or at least slowing economic growth. Do you want to start there, or is there something burning even more brightly on your radar?
Yeah, no. I mean, I think that the one thing that really got everyone's attention last week was the sharp downward revision in the Atlanta Fed's GDP estimate, which was on Wednesday of last week, 2.5%. And on Friday, it fell to minus 1.5. So that's a fairly sharp revision. I went back and looked because I'm a nerd at whether we've ever had a one-day swing in the forecast of that magnitude. And we have, not surprisingly, during the whole COVID whiplash experience, where growth, you know, was forecast to be down 35% and then was up 10% and, you know, all over the place. The only other time we've seen any numbers this dramatic were also in the first quarter, which tends to be extremely volatile for reasons that should be obvious, because you come off of a really holiday inflated end of the year, and it tends to wreak havoc with the numbers because the statisticians can't keep up with the seasonal swings. So anyway, but obviously the Atlanta Fed number was just a reflection of this barrage of much weaker economic data that we've seen over the last several weeks. And as you alluded to in the outset there, Adam, that weaker data has come alongside signs that inflation is reaccelerating. And I know you and I talked about this in prior Monday macro conversations, where we have this sort of stagflationary backdrop where the economy is clearly decelerating, but prices are sticky, and people are really, you know, it's putting a lot of stress both on consumers and businesses. And, as relates to the latter, this potential increase in tariffs that we're going to see in the next few days obviously only compounds the problem. So we'll see how all that plays out. But I think, you know, my broad takeaway is that we have this situation where the economy is clearly under stress, and inflation is sticky, which is probably going to limit the Fed's capacity to rush in with the fire hoses, which would be their natural tendency. And that should be a real headwind for the markets. So up until last Friday, it looked like that was, in fact, starting to be the framework that investors were starting to say, look, you know, clearly things are decelerating, but the Fed's hands are somewhat tied. So we might not get the reaction function that we're used to. And that's bad news until, of course, Friday, when all sins were forgiven. So we'll see what this week holds. Obviously, we got another barrage of data to digest this week, punctuated with the payroll number on Friday. So I suspect that we'll be due for a little more volatility this week, and maybe a little less volume as people wait to see what that Friday number gives us. That's sort of a broad rant, and I guess
no, it's great. So a couple threads to pull there. So the GDP Now data was shocking to a lot of folks, right? I mean, massive change overnight. And it's I mean, negative 1.5%. That's a recessionary reading. Now, folks, GDP Now is this real-time calculation. It's pretty volatile. It's not necessarily going to stay down this low. And what I've been reading today, Steph, seems to suggest that what really drove that was the increase in the trade deficit short term, basically because people are front running the tariffs.
Correct.
Right.
Yeah.
So my question for you is should people look at that and say, oh my gosh, this is sort of recessionary and the economy is really slowing, or is this more messy data because people are trying to position for really kind of a politico-economic, policy change?
Yeah, no, that's an excellent question, and it gets back to my point a little bit about the first quarter and how volatile it tends to be in general. When you have weaker quarters, remember when we had the technical recession that was not a recession, that was the first and second quarter. So you tend to see the weakest quarter of the year tends to be that first quarter number. So having it be negative, especially now with another full month of data to go, isn't altogether surprising. And then you layer on what you're talking about, which is front running the imposition of tariffs. And honestly, I thought that would have been a factor in the fourth quarter number, because it's not like anyone wasn't aware throughout the entire campaign that Trump was going to impose tariffs as soon as he came into office. So I expected on November 5th that businesses would start to import ahead of the tariff imposition. And for whatever reason, the fourth quarter, you didn't really see any of that. So it's, if anything, they're scrambling now because maybe they didn't take him seriously. I don't know. And now they're really rushing to bring in as much as they can ahead of the tariff threat. The interesting thing, though, is that presumably, if you're importing goods in anticipation, you're bringing forward, let's say, your purchases, you're basically bringing them forward into inventory. So what the trade numbers take us away, inventories should offset that, I guess, is my point. So if you're importing and that's a drag on GDP, then if you're putting it into inventory, that should offset it because inventories obviously are additive. So the fact that that's not really what's happening, as evidenced by the minus 1.5% estimate, suggests that there is some more broad weakness in the economy. And you and I have talked about this for ages. My focus is the consumer. And by any variety of measures, the consumer has been in recession. I look at consumer spending deflated by prices. And when you look at things like retail sales, which obviously is mostly discretionary consumption, and you adjust it for the increase in prices, what you find out is that unit sales, the actual number of things people are purchasing, has declined for over 2 years now.
Wow.
So that's, you never see anything like that outside of a recession, and not just a garden variety recession, but a really significant recession. So you've seen that. And then other things, you'll relate to this, Adam. I view spending on your pets as sort of non-discretionary. This is the last thing you're going to cut. And if you go and you look within the consumer spending numbers at pet spending in particular, and deflate that, what you find out is that's been negative year on year for 28 months. So almost 2.5 years. So clearly the consumer is under duress. And you see that in a variety of things, credit card delinquencies, obviously being the most cogent one of those, but also in the latest batch of consumer sentiment and confidence readings where, they had sort of this bounce on the election and this sense that, okay, now we've got to change and maybe the economy will improve. And that, I guess, patience was very limited with that. So we're 2 months in, and the consumer's already saying, "Hey, where are the lower prices you promised, and the better jobs and wages and all of that?" So clearly, the consumer is still struggling, and not getting any relief in terms of inflation. So I guess what I'm getting to is that it's not just a front running tariff story that's holding down GDP, but it's a continued pressure on all the segments of the economy that have been suffering heretofore, which is these consumers and small and mid-sized businesses. So I don't see where that really is going to change. Absent substantially lower interest rates, and we don't seem to be getting that.
Okay. So yeah, I think I've talked about this with you. I've talked about it with a lot of people on this program, about if I were advising President Trump, I would be encouraging him at this point to sort of warn the American people that we've talked about. He's got disruptive policies that in and of themselves may cause some economic pain and with market implications as he tries to affect them. But also he inherited an economy that had a huge overhang of all the unsustainable issues that you and I have been talking about forever, right? So in other words, the odds coming in, I thought the odds of an economic slowdown were high enough that if I were running the show, I would be trying to tell everybody, hey, look, it's even worse than I thought, now that I'm here, and but gosh, you're lucky I've got this great plan, but it's going to take time to effect. And so we're going to go through a bit of a hard time here as we do the necessary changes, and everybody, we're going to have to tighten our belts together. And there's a greater good to, for us to all pull together for here, and to try to just manage expectations that it's not going to be just all sunshine and roses here, right? Because I don't think it would be, Trump policies or not. And the danger of not doing that is that there is an economic slowdown, and you're still stuck in it or close enough to it that by the time the mid-year elections come up, people are still feeling bad about their personal situation and they're resenting you for it, so they go vote for the other party, right?
Right.
And Trump hasn't done that so much yet, but what I did see over the weekend is that Treasury Secretary Scott Bessent has now started kind of delivering that message, right? So it seems like they're kind of saying, hey, we need to start foaming the runway here a bit, right? So are you seeing that?
Well, it's funny, as you were teeing up the question, I was thinking, well, I was going to mention that Scott Bessent did say, and was saying for a while, that he believed that the economy was in recession. And I guess his remark recently was sort of noting with a little bit of cheeky sarcasm that this recession has been underway while the mainstream media insisted that everything was fine. And then, of course, the minute Trump takes control, suddenly the recession is in fact here. So, but notwithstanding that, I mean, I think your point
is Trump's fault, right? Even though he's 30 days in office,
exactly. So he gummed up the works. But all that being said, clearly, Scott was aware that the economy was slowing, and his sense, I think, has been all along that the economy is substantially weaker than the data had indicated. As to whether he is able to persuade Trump toward your idea that he should really let people know, like and he has said, we inherited a mess and it's going to take a while to get through it, but he needs to really drive that home as to how it relates to the average person out there. We'll see if he does it tomorrow night with the State of the Union. He may really use that opportunity to underscore just, he'll probably describe it as this tremendous mess that he walked into. But what he needs to do, as you're suggesting, is to then tell people, like, it's going to take, let's give them a sense as to, how long it's going to take before they're actually going to see some relief when they, go down to the grocery store, or fill up their gas tank, or in terms of better employment prospects, et cetera. because that's another thing that really took a hit in those confidence and sentiment measures. It wasn't just inflation going up, but inflation was going up at the same time that employment prospects or labor picture was deteriorating. So that's a pretty bad combo. And I think, there's some concern with the Doge stuff that they're just going to walk in there with a chainsaw and just cut, 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 and that's going to impact people, throughout the economy, because it's not just people who work for the federal government, but then you have contractors, independent contractors and their workers, et cetera. So there's a lot of concern and insecurity out there that he really needs to speak to. But ultimately, the problem is that these problems can't be solved that quickly. It really is going to take time, and it's going to take pain, and nobody has an appetite to take any pain, least of all politicians. So this is the struggle, I think, is that the markets got very excited about the idea that Trump was going to come in and cut deregulation and cut taxes and kind of remove these tethers from the private sector that have been restraining activity. And he's trying to do that, but it's not that simple. There's a lot of issues for him to deal with in terms of getting all this done. And then, there's immediate things like if you think that there's going to be enormous saving from slashing all these redundancies in federal agencies, well, you may lay off however many thousand people, but you're still paying them severance for a short period of time.
Right.
So they just go from collecting a paycheck to collecting, some other support. And then eventually, if they can't find a job, you're paying them unemployment. So they don't just disappear from the government dole. They just kind of change the label that they're categorized under, at least initially. So, even the best things that are being implemented long term will be great, but the process of getting from here to there is going to be painful and not smooth and easy. And the markets seem to have been discounting this immaculate reversal to a vibrant economy.
Well, and that's what's been so interesting. So, middle of last year or so, beginning of last year, we still had a lot of arguments about whether a recession was going to happen or not. By middle of last year, it kind of the no landing scenario won out. And really, recession fears have been absent the headlines until like the past couple of weeks. And they're now all of a sudden creeping back in. Of course, the GDP numbers really got a lot of people's attention here. So anyways, to me, it may be seeming that the Trump lieutenants are getting the message to go out and talk more about, hey, folks, we're going to have some hard times given the sins of the past, not our fault, but the old guys, the old regime's fault. Where I was kind of going with this is I have read it recently that in Trump's first administration, there was a Trump put on the market, and the Trump put was on the stock market. Trump was using the stock market as his daily scorecard for how I'm doing, right? Yeah. S&P was up today. It must be doing great, right? Yeah. And they're now saying there is still a Trump put, but it's been switched. Now the Trump put is on the 10-year. And the speculation is that Trump may be a lot more willing to let the stock market do whatever it needs to do, as long as they're getting borrowing rates down. Do you think that's an accurate comment?
Oh God, I'd be surprised if that were true. He seems to, even up until, let's say, a month ago, was touting the stock market as a reflection of, the excitement about
the excitement that he's coming in. Yeah.
Yeah. So, I would be thrilled if that were the case, because I think we need to expunge the excesses that have been built up for so long here, and take the pain. And the fact that he's not running for re-election gives him the perfect opportunity to take that pain.
Right.
But he may be, I don't know how much they're focused on this, but maybe he feels like I'll take that pain, but I want to take it after the midterm so that we at least establish a strong foothold here, and then we can take the pain after, and that's fine because we'll already have, a really resolute core
Is that
constituent.
a real? I'm just curious. Sorry to interrupt. Is that a realistic expectation if you think we're going to have the economic slowdown, between now and then?
I know. I mean, I think it's just impossible. The whole scenario is impossible because you've got an economy that is kind of crumbling under the weight of higher interest rates, but the Fed can't provide relief because the inflation numbers are still sticky. Not only
Mhm.
are they above the target, but they're moving rapidly higher, on an annual rate. We're running at 4.8% on the CPI now, annualized. So 2% is way,
Right.
off the radar. And obviously you're seeing things like, egg prices going up and whatnot. And then you've got the unknown of how the tariff thing fleshes out. I mean, it wasn't inflationary in terms of feeding through to the CPI in the first Trump administration, but that doesn't mean that it will work out the same way this time. I suspect it will, just because, the inclination of China and Canada and Mexico and whatever to offset, to try to take the hit on their end rather than passing it on to US consumers would presumably be even higher today than it was back then, just because their economies were in better shape back then than they are today. So they're in a economically weaker position now. But who knows? So I think the upshot is that it's going to be really hard to navigate this um, in terms of threading the needle of getting the economy not to go into recession before the midterms, and or the stock market not to decline
Mhm.
before that. And that is why the one thing I feel, and I just saw Dave Rosenberg on Bloomberg picked it up, him saying, the one thing I wouldn't be doing right now is making big bets. And I couldn't agree more. It's like we live in a world where uncertainty abounds and the market is priced for perfection.
Right.
So, and I'm not just talking about stocks. I mean, look at credit spreads. They've started to edge higher. And interestingly, they did so even on Friday when the stock market had that rip snorting reversal. Credit spreads continued to widen, and junks and investment grade bonds continued to move higher in yield. So maybe that's a sign that credit investors, anyway, are starting to get a little antsy about the outlook. But all in all, I mean, I think this is the one most succinct conclusion we can draw, is that the economy is probably decelerating and potentially going into recession, and the market has allowed zero room for economic error. So it just seems like a very fraught and risky situation.
A fraught time. So this is probably pretty obvious based on what you said, but from an investing standpoint, it sounds like you're saying the odds are to the downside in this uncertain environment, and therefore it's probably better to be playing a conservative versus an aggressive game right now.
Yeah, well, I mean, I'm going to remind the audience because there will be people who will berate me for having been negative on stocks forever. And I
Mhm.
have been, because it's a bubble and it has been a bubble for a long time. But what I recommended people do was get into gold, and gold outperformed last year. It's outperforming this year. So, as much as I might have, quote unquote, missed out on the rally in stocks, which again, I think is just, I exited prematurely because it's a bubble and I don't know how to
Right.
time its deflation. The place where I recommended people go actually has
Has
been the place to be.
to be. Yeah.
So, and I would continue to be long gold. Last week's action notwithstanding, I mean, I think that was just kind of the weak hands exiting the market, people who had been speculating in gold, who felt like, okay, it's gone as
Right.
far as it can go.
And it had run so far, so hard. You
Yes,
have to have some pullbacks, to
absolutely.
make it a healthy continued rise. Yeah.
Yeah. And I mean, at the end of the day, what we're talking about is an environment where, it's going to come down to a contest of which lever are we willing to pull? Are we willing to let interest rates rise to a natural, acceptable rate to finance $36 trillion in debt?
Yeah.
Or are we going to artificially attempt to suppress the backup in rates to keep the economy from absolutely imploding, and in the process cause the dollar to be the valve for the sins?
Right.
And
So I will, sorry to interject, but
yeah.
convince me it's not going to be that route.
Right. No, I can't. I mean, I just, the idea, and as you said, if the Trump people are now pointing to the Treasury market as the barometer of their success, the last thing they're going to want to do is see Treasury yields moving back toward 5% on the long end. If that's the arbiter of quality policy by the Trump administration, I would be very doubtful that they're going to let rates, rise to the levels that a natural supply demand dynamic would require. So I do see the dollar being the valve, and that's why I've been in gold all this time. And I think that's why the BRICS countries are all plowing in there as well.
So let me ask you this, Steph. And I'm going to ask you one or two more questions, and we're going to get to your charts, and then we'll take a few questions from the audience by the end if we have time. The gold and the dollar have largely risen a lot together of late, and it's not impossible, but it's relatively rare, right? So the dollar strengthening hasn't stopped the rise of gold. Now, if the dollar starts to weaken, I mean, historically, that would mean that would add an even greater tailwind to gold.
Yeah.
Do you think that the old correlation will flip back and still work when and if the dollar starts weakening from here, or for some reason are they now much more positively correlated?
No, I agree with you. I mean, I honestly think that looking at the financial flows dollar is not so important. That's what everyone looks at, the dollar index. But if you look at, let's say, the dollar's representation as a share of global Forex reserves, we just hit the lowest level in 29 years recently. So on that basis, you're talking about the difference between a financial flows measure of the dollar and a real world transaction in the dollar, where around the globe it's just representing less and less in terms of the total share of reserves out there. So I guess, and ultimately people will say all that matters is the financial flows, because that's massive trillions upon trillions of dollars that are being traded every single day, and that's what maintains the dollar reserve standing. But ultimately, I think we're really chipping away at that as well. And that's what the BRICS plus countries are all about. They're trying to set up a vehicle, a market and a system by which they can create an alternative to the whole dollar, the financial structure. And it's not going to happen overnight, but they're making tremendous progress toward it. And in that toward that goal, they're gathering up gold reserves to make whatever currency they debut, or even if they don't have a specific currency, but they just have a reference to gold for the block themselves, it would create a real sense of a hard money currency that they're transacting in, as opposed to the dollar, which is obviously just sheets of paper that, with 36 trillion in debt that needs to be financed and no one out there buying it, will require running the printing presses over time. So
let me ask you a question. I interviewed last week. I haven't released it yet. An interview with Judy Shelton.
Okay.
And it was a great conversation. We went 90 minutes, could have gone 3 times that amount with her. the conversation, really kind of went deep into gold because she's been a big proponent of sound money for a long time, and she feels that gold is kind of the bedrock of the sound money standard that we should think about going back to. And I asked her that we're seeing play out in an accelerated time frame now what Michael Every has predicted, which is the globalization era is unwinding, and history may show that was a brief aberrant moment in geopolitical relations, because Michael says, look, for centuries before, it was all driven by mercantilism and national interests and protectionism and whatnot, and that's sort of the natural order geopolitically, and it looks like we're heading back into that now. And that's been, we've been seeing that over the past years begin to emerge in more and more countries, and then of course now with Trump's America First agenda, we're seeing that on steroids here in the U.S. And so countries are becoming much more strategic about what they're willing to give access to whom. And for the past 20 years or so, the West has been very nonchalant and happy to sell as much bullion to the East as the East is willing to buy. And so I asked her, I said, do you see at some point that changing with gold, where all of a sudden the West begins to say, hey, look, we're all of a sudden talking about auditing Fort Knox, like Besant he was a big gold investor privately, and his fund seems to have an appreciation for it. May we say, what, just selling as much to our friends and adversaries as they want, maybe we actually want to start restricting where this gold goes, and maybe we actually don't just want to start letting it leave our shores anymore, and maybe, just maybe, we might want to start adding to our sovereign treasury, which we haven't added to in, I don't know, my lifetime, I don't think.
Yeah.
So I don't know. What do you think?
Well, I think it's compelling and it would stand to reason. It's interesting to me, however, that their first shot was to talk about a crypto reserve.
I know. And I don't mean to shrug that off, but yeah, it's funny they started there versus the one that's been around forever. Yeah.
Right. And, maybe that was a stop to pick up voters. And now they feel obligated to follow through because they did campaign on that as something they were going to do. So, and also, what's the downside? I mean, I guess I could come up with downsides to it, but I don't want to get trolled on.
You don't want to anger the crypto army. Yeah.
But as to gold, I guess the only issue might be that if they were to come out and publicly say, we're really going to start to add gold to the U.S. gold reserve, and we're going to be more aggressive and, protecting our gold industry and this and that, and maybe, limiting the exports of that, et cetera. It might be viewed as betraying a concern about the dollar's reserve standing. It might be. I'm just suggesting that maybe in their, in the back of their mind, they think it's an acknowledgement that we have a problem and we're trying to address it.
I'm sorry to interrupt. Just given that risk, if you were in charge, would you still do it?
I would, because I would have campaigned on the idea that this was a problem and that I was going to come up with a solution to it. So yeah, I mean, but that's why I wouldn't get elected, because
well, who knows? Who knows? Things are going more and more, the Stephanie Pomboy way. So you might become mainstream.
I do not want anything to do with politics. Thank you.
All right. Well, look, you had sent over some charts. We haven't talked about any of them yet.
Oh, yeah.
So we don't necessarily have to, but are there any that you want to comment on for folks here?
Well, I mean, I guess I guess we could go to the second. This one, the stock market cap to GDP versus consumer sentiment. I think that gets to the point I was making earlier about how, the economy and the consumer especially have been struggling, but the markets have completely, almost capriciously ignored it.
And my apologies, Stephanie. I put the chart up here, but it looks like it has a transparent background. So folks can see the lines, but they can obviously see our faces behind them.
I was trying to think of how there is a way for me to share a
To share a
screen.
screen. You know, I'll find a way to share the screen. You talk to it, and I'll do that work.
Okay, well, no, there's no problem. Let's see if but yeah, so the point was just that when you look at the situation with in the economy versus what's going on in the markets, it's a tale of Main Street versus Wall Street. And you've had consumer sentiment that's been in recession territory, while the stock market cap to GDP has been hitting all-time record highs. So I think that here we go.
Do you have it?
Is anyone seeing that? Is that
Perfect. All right, great.
okay?
I
That's
was
top
just
chart.
about to do the same thing, but yeah, there we go.
Okay, so you just, you watch this, look at this consumer sentiment chart. I mean, it'd be hard to argue that that's not a recessionary chart. And then here's the stock market. So, this I think is just an example of how the market's just been absolutely priced for perfection. And I have to assume that this empty space here is justified by the expectation that the Fed is going to cut rates, to solve this problem. And again, the current inflation backdrop suggests nothing of the kind. The other thing that I thought was interesting is on this bottom chart, which hopefully you can see on the screen too. Last week, obviously, and over the last couple of weeks, we've seen a massive rally in the long end of the Treasury curve. And I thought this was interesting because last week in particular, I wanted to see how much of the short position, which has been substantial, was covered. And you can barely see it. It's this tiny little blip. I think it was about 3,000 contracts. So the point here is that there's a lot of room for specs who are currently betting on higher rates on the 10-year to cover those positions as they concede to the reality that the economy is slowing rapidly. So this is juice for a further rally in the 10-year bond yield. That being said, my sense is that the rally in the 10-year will ultimately find a floor much higher than prior economic downturns by virtue of the fact that we have this recessionary deficit situation before we even go into technical recession. So, I went back and looked at when we deflated the dot-com bubble and had the recession associated with that. And then again, when we had the global financial crisis, both times you had a massive mushrooming, not surprisingly, of the deficit relative to GDP. So in 99, 2000, when the dot-com bubble burst, we were actually running a surplus of 2% to GDP and a budget surplus of 2% to GDP. And that very quickly switched to a 3% deficit almost overnight. In the global financial crisis, we went into it with a deficit that was minus 1% of GDP. And that promptly went to minus 10% of GDP. Our starting point today, if you believe, the most flattering numbers, is 7%, minus 7%. That's our starting point. So if we have any kind of significant slowdown in the economy, or heaven forbid, a repricing of risk that's significant, you could see that go easily to 10, 12, 15% of GDP. I mean, we're talking about massive numbers here. And then, how low do treasury yields go in that environment? The only way that they can go down would be for the Fed to come in there and buy every treasury that's issued, in which case, again, the dollar becomes the veil for our sins, to the benefit, one presumes, of gold.
So let me ask you this, Steph. So it sounds like, I'm sure your investing outlook is broader than this, but it sounds like you're like, okay, gold, still own it. Lots of good reasons to own it. Think it's going to do well. I know you've had a lot of your position in safe T-bills, right? It's been a great time to sit in safety and get paid a real return for it, right? And it hadn't been the case for a good while. Where are you on the long bond side of things? Because given what you're saying, I could make the argument for you that, we're going into recession, or at least a steep economic slowdown. Investors are going to get panicked. They're going to seek safety. They're going to run into the T-bills, or they're going to run into Treasury bonds. And if that doesn't bring yields low enough to help the economy recover and get out of this, the government's going to come in and make up the difference, right? They'll start buying hand over fist, like you just said, right? So you can kind of make an argument that materially lower long-term Treasury bond yields are in our future here. And then some people might say, great, well, I'll buy them, I'll get paid along the way, and then I'll get the capital appreciation as that happens. Now, there's risk in there. And my question to you is it too much risk to not take the bet, or are you getting increasingly interested in this bet?
Well, I think it's a trade. So for the reason I just cited with that spec position and a lot of shorts that need to be covered, and I presume they will be covered in the process of discounting this recession. You could get a run in the 10-year that brings yields, clearly back below 4. Could we get to 3.5, something like that? Perhaps. And then at that point, I probably would
get out.
I'd say that's enough. I'm going to now move entirely into the front end of the curve and just hunker down there. And for, that, I don't know if it's even worth playing that, but,
well, that was my question. Is it worth playing, or is it, there's enough uncertainty here that's like, leave that for the stronger stomach?
There's enough uncertainty, especially when we talk about the inflationary setup. If you got a situation where this time, even though it didn't work out that way in the first Trump administration, some of the tariffs actually do feed through to the CPI, then you're talking about an environment where that decline in the 10-year would be limited, would be far less dramatic. But I do think we'll see a meaningful move in the 10-year, maybe 50, 60 basis points for sure. So if you feel like you want to take advantage of that and you're a good trader and you are willing to position that, go for it. I'm not, I don't really have the bandwidth to do that. I'd much prefer to just sit here at the front end of the curve, collect my 4% and not be a hero, because I feel like gold is paying me enough between gold and the gold miners, which I think now we're reaching the point where you want to start to move from gold to the miners.
From metal to miner, yeah.
I think you had to get a movement in the bullion that was substantial enough to persuade people to touch the miners, because the miners are legendarily horribly run, and they just can't seem to get anything right. But they are trading at levels that are so absurdly cheap relative to the bullion that even a monkey should be able to make money, running a gold miner. So I think we've reached a point where, as we near 3,000 on the bullion, you want to start to leg into the miners and maybe overweight that. I'm still holding bullion, but at the margin, I'm adding more and more to the miners.
Yeah, I just did an interview with Tavi Costa, who produces a whole bunch of phenomenal charts. But he had one chart, Steph, that if you haven't seen, I'll send it to you. It basically tracks, I think, the price of the mining sector versus its free cash flow.
Okay.
And like, we've never seen a divergence like we've seen right now, right, where free cash flow has just done a moonshot.
Yeah.
And the price the price of these stocks hasn't caught up to it yet.
Yeah. And, that's another thing that actually gets a little bit of support from the current administration, because a lot of the environmental red tape was an issue for these gold miners. And so having that be removed eliminates another potential headwind that these guys were facing. So that's, I feel you said maybe I have a more diversified portfolio, but I really don't. I mean, I've got my cash in the form of T-bills. I've got gold and the miners and a little exposure to the emerging markets, but nothing significant, just because I think on a relative basis, I'd rather have exposure to emerging markets than to the developed world markets for all the reasons that we've
talked about.
here. So,
hey, folks, so I'm going to grab a couple questions from the live chat here in the remaining 12 minutes or so we have left. So as you have questions, please ask them in there, and I'll start pulling them. While I wait for folks to put their questions in there, Steph, I'm just curious. So again, this is me intuiting what you're doing, so correct me if I'm wrong, but my sense is that you think the size of the correction that will occur, either because valuations are extremely stretched right now and just need to mean revert at some point anyways, also add in the fact that the economy may indeed slow the way that you think it's going to, and that's going to pull valuations down as part of that as well, that you think that's going to be material enough that rather than trying to be aggressive and shorting that or whatever, you're going to play it safe, and you're just going to have a lot of dry powder so that when these material price corrections happen, you can start deploying capital at really attractive valuations.
Yeah.
Is that true?
Absolutely. I mean,
Okay.
I think that there will be tremendous opportunity on the other side of this to finally invest in good quality US companies at prices that are actually reasonable. And that'll be the first time in a very long time that has been the case, in my view. I mean, we've been really living in bubble territory for a very long time, and largely because every time it looks like the market is about to cleanse itself and the economy to cleanse themselves of the excesses, our policymakers rush in and prevent that from happening by basically saying, here's some cheap capital, borrow more to sustain your failing business model. So it would be a refreshing change of pace to actually expunge the excesses. I will say we have seen a lot of, let's call it creative destruction in the small and mid-sized corporate space, where corporate bankruptcies last year were the highest since the global financial crisis. So there have been a lot of companies. I mean, the fact that Hooters is going out of business pretty much tells you things are pretty rough out there,
Pretty rough.
right?
when you can't win with sex on your side.
Exactly. That's
and on that too, you mentioned earlier, signs of retail spending contracting when you look at it on a unit sales basis, right? One of the things that has been keeping the averages high. So a couple of things have been keeping the averages high, right? One is just inflation, right? Yeah. If you're looking at the dollars spent, they've remained in the same territory, but that's largely because even though they've been buying fewer things, those things have cost more nominally, right? Right. So you obviously have to look at the inflation adjusted stuff. But also the top 20% of consumers that make up an unfair share amount of consumer spending have been kind of keeping the average steady, right? But we're seeing increasing signs, at least that I see by news articles and whatnot, that they're starting to see cracks there in that crowd. And obviously all the toys, the ski mobiles, the ATVs, the RVs, et cetera, like those sales are now getting crushed. We're seeing brands like the Louis Vuittons and the luxury retailers, reporting disappointing earnings going forward. In fact, Walmart stock's actually done really well for a good while because a lot of the high-end consumer was starting to downshift and spend there. But now, was it a week and a half ago, Walmart stock got walloped because it had fantastic earnings. But then when it was giving its forecasting, it was saying, look, we think across all our consumer segments, we're going to see things not grow so much. So even the wealthy, folks there are beginning to not look like they're going to spend as much going forward. So I guess my question is are you concerned about what you're seeing at the high end consumer? Because as they go, they'll probably begin to really pull the averages down with them.
Well, I'll say, and regular subscribers to Macro Mavens are well aware of this, that Walmart relative performance has been a bellwether of mine for a long time. It is a classic economic bellwether. So when Walmart is outperforming, generally the economy is slowing and possibly going into recession. And when it begins to underperform, you've probably reached the bottom in the economy and things are starting to improve because people now can, become more aspirational. So that completely underscores the point you were making as relates to the action last week for Walmart. Um, it was a one day, their earnings number came out, the stock got hit, and it went right back to outperforming the S&P again. So this is, people are now acknowledging that things are difficult enough for consumers out there that they have become Walmart shoppers. And even Walmart is seeing that it's starting to hit across the constituents. I do worry about that. And I worry about the high end, particularly as relates to my expectation that we're going to see the markets finally revert to some more normal valuations, because that top 20%, that's where, all their confidence comes from anyway. The wealth effect is being driven by them. And if not actually spending the dividends that they're getting on their stocks, at least psychologically, they're spending the dividends that they're earning on their stocks. So,
right. And by the way, this cooling off on the high end is happening with stocks still near all-time highs. Right.
And
imagine what it'll be like if the market starts selling off, right?
Exactly. Another barometer that I like to look that relates to that is if you look at, let's say, the Wilshire 5000, take the broadest stock index out there, and overlay it with the quits rate, the job quits rate from the JOLTS report. Normally what you see is that stocks and the quits rate move together. As stocks go up, people are more emboldened to quit their job because the economy is good and they feel like they can go out and get another higher paying job. We have seen in the last several quarters, the quits rate absolutely collapse in the face of higher equity prices. So clearly there's insecurity out there that, again, the markets are not acknowledging. And I think that gap is going to be resolved, and it's going to be resolved by the markets coming down, not by the economy miraculously going up.
Right. Yeah, I have. It's sad that this is coming true, but I think starting about 2 years ago, I was saying, look, I think one of the more predictable headlines going forward is that the Great Resignation is going to turn into the Great Please May I Have My Job Back movement. And I think we're now there. We're certainly at the please don't fire me stage of it.
Yeah, except as relates to the Doge thing, I guess. If you can't reply to an email, then I guess don't let the door hit you on the way out.
Well, exactly. And of course, if you look at what's happening in the real estate market outside of DC, it's getting just clobbered right now. I got to verify this, but I think I saw a headline yesterday that said something like the average house price has dropped by like $150,000.
I saw that. Yeah, I saw exactly that headline. Yeah. Yep.
Yeah. So yes, and so we haven't even. Again, lots of trends that make you nervous, and a recession just makes them all a lot worse, right?
Yeah. Absolutely.
Yeah. Okay, so some rapid fire here. First off, I was going to pull these up, but I can't find them in the sea of comments here now.
Yeah.
One was a great comment by this guy, Dr. Zen, saying, "Hey, I only go to Hooters for the articles," which I thought was very funny. One was, what kind of dog does Stephanie have? So Wilhelmina has not joined us that I've seen so far this conversation, but do you mind sharing her breed with the
Not audience? At all. I mean, she was actually under the desk snoring away, so I'm pleased that no one was hearing that. Although maybe the person who asked the question was deafened by it. She is an English bulldog. So
okay. English bulldog. All right, and such a cutie. All right, so question here: if there's a peace deal between Ukraine and Russia, will oil go way down?
I think that the surprise to me has been that oil has stayed where it has even after Trump was elected, because he campaigned on drill, baby, drill,
right,
and ending the war in the Ukraine. And you would have thought that the markets would have anticipated that starting November 5th.
And then you see oil go down for expectation of future supply.
Yeah. And you just haven't seen it. And it's doubly surprising given the collapse in economic activity that we are seeing. So, if it hasn't gone down heretofore, I have to imagine that there are other things, namely, lack of supply, that are keeping it where it is. you'd need to hire an oil analyst to give you a real insight on that. But the demand situation is clearly fraying, and yet prices aren't coming down. So, you know, I don't think that it's that people imagine this Ukraine imbroglio is going to last forever. But you know, you also still have Israel, and then the talk about how that ceasefire may not be holding. So there's plenty of unrest around the world. It makes me not inclined to be bearish on energy. I will say that. I mean,
Okay, so someone asked here, is Stephanie bullish energy stocks? Do you have
yeah.
a quick answer to that?
I mean, I think that I am bullish commodities in general and gold and oil in particular, just because they're strategic resources.
Mhm.
But in broad generalities, I prefer hard assets to paper,
Mhm.
especially right now. So I would be overweight, basically a basket of commodities. If you wanted to be long, you know, let's say the CRB relative to the S&P. But within the commodity basket, I definitely would emphasize gold and oil. And then I'd probably be a little reluctant to be aggressive about things like copper, where it's such a function of global
Of the
growth
of economic growth, yeah.
and housing in particular.
Yeah. By the way, Tommy Costa, one of the charts that he's most known for is the ratio of the S&P to the commodity index,
Uh-huh.
and it plummeted over the past decade or so and has been
It's
just
starting to
bouncing on the bottom. It's still down there at the bottom. Like if this thing ever does mean revert, commodities look like they're going to go ballistic, right?
Yeah, I mean, even after the move we've seen so far, which, you know, has been significant from the standpoint of commodities, it's almost imperceptible on that long-term chart
Yeah.
relative to the S&P.
Yeah. All right. Well, look, we got to wrap it up here. A couple quick things, folks. One, if you continue to enjoy these biweekly Monday morning macro sessions with Stephanie, please let us know in the live chat, and we will continue this. As a reminder, this is mostly me giving Stephanie an out here. We talked about trying this out and seeing how it went, and if it worked well for everybody, for Stephanie, for the audience, we'd keep it going. So obviously, your input will be important in that. Final parting question here, Stephanie, and I'm going to unfairly ask you this question with the completely erroneous assumption that because you happen to live in Florida and you happen to live not that far from where Mar-a-Lago is and all the action there and on White House South or whatever they call it these days, what impact, if any, meaningful impact, if any, do you think Friday's drama in the Oval Office will have on markets, the world? The whole, hey, we were just about to sign this deal, and then the whole thing went south in the press conference beforehand.
Wow. Well, I have to believe that the deal will get signed. And this was, you know, just as Trump said, great TV.
Yep.
But you know, I think that the deal will ultimately get signed. And I think it's very interesting that the administration is now sort of taking a page from China's playbook, and they're getting into sort of a Belt and Road type of approach. And thank goodness, because we've been sleeping during this entire period where China has been basically procuring strategic resources all around the
All over
globe.
the world, yeah.
So the Ukraine thing seemed like a no-brainer. I think conversations around Greenland and stuff like that will continue to percolate. But you know, as relates to the markets, it's just another example of the uncertainty and the volatility that you would expect the markets would begin to react to. And maybe they are. You know, maybe we're finally starting to see an acknowledgement that it's not going to be. Even if we're moving in the right direction, it's not going to be smooth sailing.
Really.
So we're going to have to buckle up a little bit.
All right. A question that I'm going to ask you next time, so don't answer it now because we're at the hour and I'm going to let you go. But is volatility a good trade? And if so, how would you do it? Right. And
Oh,
I know
yeah.
there are some people I've interviewed who said they think volatility is going to be a great trade for
Yep.
2025. But I'll
Yep.
let you noodle on that, and we'll leave that as a cliffhanger teaser for your appearance here in 2 weeks. Stephanie, thanks so much. And just glancing very quickly at the live chat here, people are saying this is, they love it. Let's keep this thing going. So at least from the audience side, this is working. And if it continues to work for your interests and needs, let's keep the show going as long as it's working for you.
That's awesome. Thank you so much. And thank you, everybody. And next time I'll be sure to get Wilhelmina out here.
All right. It's so great to have you back, Steph. Thanks so much.
Thank you. Have a great week.
You too. Everybody else, thanks so much for watching.